Flip on my video. Well, welcome to webinar 3 of the Frontier Angel Accelerator. My name's Looney. I'm from Fledge. I'm here with my partner, John Seacrest. And standard housekeeping to start with, right? Put yourself on mute to start with, but please don't expect to stay on mute the whole time. We do want to hear from you. I know Avery is watching the chat window, and John should be right now as well. Put in questions there if you want, or at any time, just come off of mute and just interrupt us. We like to be interrupted. And this is being recorded, so if you're watching at home, thanks for joining us late. All right, the agenda for tonight is a quick recap of what we're talking about in terms of Angel Accelerator. And then I will talk for a bit about how it changes to select the companies for your accelerator once you start investing in them instead of anything else, instead of either charging them or providing it at no cost. That will change how you deal with these companies and how you pick them. Then John's going to speak about due diligence and his techniques. And as I said in the very first webinar, he and I don't always agree on everything, and we're going to disagree on this one a bunch, I think.
We'll see.
Yeah, we'll see. And then again, we're open for Q&A and Q&A at any time, but we'll leave some time at the end in case you like the end. So just to backtrack from what we talked about in the first webinar, we're talking about two different styles of the same program. And so the goal of the program is to teach people how to be angel investors in order to have more angel investors in your home city, in your ecosystem. And so John has been running for the last 7 years here in Seattle, the Seattle Angel Conference. They have just about finished, almost finished their 15th session, has over 300 graduates. And the way it works is that you recruit a bunch of angels, depends on the city exactly what the numbers are, but here in Seattle, it's $5,500 per investor. The goal is 40 investors. $5,000 of that $5,500 is put into a pool that is used for an investment, and $500 is covering some of the cost of running the program. And then while you're recruiting angels, you're also recruiting companies to participate in a business competition. And the angels are going to pick one company to invest $200,000 in, right? If you get the 40 angels. And then during the program, it's 12 weeks long. And while the angels are present, they are physically doing the due diligence and the conversations with those entrepreneurs and with each other to winnow that list down to 6 finalists. Then there's a demo day. There is a big pitch event. People pay money to come to this event. Here in Seattle, we get about 200 people who show up at this event. And then the angels, they disappear for however long it takes. An hour or so seems to be the norm. And they pick one company to make that investment. And they've done the terms ahead of time, and one of the angels is kind of being the lead, and it works. And it's worked here in Seattle. It's actually a copy of a program that worked in Oregon. John is busy teaching 3 more cities in North America how to do this, including one in Canada. There's another program like this in Norway. This is a program that works. And the idea of the Angel Accelerator is to take the key parts of that program and use it to fund a startup accelerator with, at the same time, an angel accelerator. And so the straw man numbers, which we haven't done here in Seattle yet, is $11,000 per angel, $10,000 for the capital, and a $1,000 fee in this case, because there's fewer angels. The goal is to get 25 angels together to create a $250,000 budget. And that would then provide, with 25 angels at $1,000, a $25,000 budget to pay for the Angel Accelerator. 250 is about what we spend to do the Startup Accelerator here in Seattle. And then the key difference is that it has to be longer because we've got to recruit the angels in time for them to pick the startups for the accelerator. I highly advise that every startup that comes into an accelerator gets an investment, ideally the same amount to start with. So those angels are picking their investees, multiple. And then during the program, while the startups are present, the angels are then being taught how to be lead investors. So What may be true, what we're going to test out here in Seattle, is maybe the best way to do the Angel Accelerator is to get alumni from the Angel Conference so that they have some knowledge, and then teach them the next bit of knowledge for the Accelerator. And we will be rolling this out as far and wide as we can to see, well, maybe that's not true. Maybe we can get the angels in, guide them on how to pick the companies, and then have them come through and learn how to do the follow-on investments. So that's what we talked about in webinar 1. That is the program that we'll be rolling out. And to help make this possible to do around the world, what we'll also be supplying to all of you who want to do this is a complete set of curriculum that John and I will be recording and putting up on a website that you'll be able to sign up for, and share those videos with the angels so that you don't need to know how to do this all yourself. We're going to help arm you with not only the knowledge of how to run the program, but the knowledge that these angels need to get up off the ground and start doing this themselves. All right. So if there's no questions on that, and I'm not seeing any in the chat window, but then I'm going to jump straight into what happens when you do an accelerator where you invest in every one of the companies. And so that starts out with this question of, how do you pick the companies today? So what criteria are you using to select the invitees? And I've run all sorts of programs. I've run programs where the criteria was they were willing to pay the check. Right? They had at least an idea, but really mostly the reason we selected them was because they were going to write us a check. And I've also run programs that were grant funded where we picked companies that we liked because we could. We had a limited amount of grants to bring them in. And in that case, we were picking companies that we thought needed the help the most, not necessarily the ones that were most investable. Or are you choosing the ones that are the most investable because you have some other means of investing in them, or you have a group of investors around right now who are looking at your graduates? And the next piece of question that you need to ask is just how many companies can your local ecosystem fund? So here in Seattle, which is, I've talked to people around the world, but I've done this in Seattle for 7 years. I was running a program that was doing 2 sessions per year, 7 companies per session. So 12, 13, 14, 15 companies per year graduating. And when they were mostly Seattle companies, that was too much for the ecosystem to handle. That was too much for the number of impact investors that I had here. And that's one reason why Fledged became so global, is because I could bring in companies that needed help from other cities, teach them, arm them with how to raise money, send them back to their cities and expect that they would find investors there, which was mostly true. And so I do want, and it's also one reason why Fledge is the scale it is globally at the moment, because we could have 100 cities running right now, but that would overwhelm the entire global ecosystem for impact investing. There just wouldn't be enough money to supply the capital for 700 companies per year. So we have to look at we have to balance this list of how many do we want to bring in, how much can the ecosystem that we're targeting support, how hard is it to go find that money, how long does it take? Second piece here, and the reason why I really like the investing style of accelerators is point number two here, is that you tie your success to their success. So if you are taking the capital that you're raising and you're handing it over as cash to these companies and expecting them to pay you back something someday, then you're only going to get paid back if they succeed. If they fail, if they blow up, if they don't do what they're planning on doing, you don't get the money back, and you will eventually run out of money and fail. And so in this case, you're aligning your interest with their interest in the long term, not just the few months that the program runs. Because in the end, they don't need help for 2 months or 3 months or 6 months or a year. Every startup needs help for years, plural. And so this gives you an incentive to keep helping them. And once you do that, your choices will change. You will definitely start to look at these companies as far more like an investor looks at them. Um, and this doesn't mean you have to stop doing what you're doing. What I've seen, many of you have talked to Keith Ipple, we will be launching Fledge Vancouver someday. And when we do, there will be this shift. He's not going to give up all the programs that Spring is running right now. We're going to add one more. And that program is very likely going to turn into the flagship program in Vancouver for impact. And we've seen this already in Alaska, in Anchorage. They're running programs right now that are grant funded, and they're raising capital to do the flagship program, which will be the investing program. And so it shifts the focus on your whole business toward, great, I got companies that are idea stage, and I got companies that are investable, and companies in between. How do I help them all the way through until I can get them to the point where we can invest in them, because then you can make enough money to be sustainable. So it ties back into the other theme on sustainability. All right, point number 3, is there enough deal flow in your home city? So I quickly, when I started Fledge, the answer was maybe. Maybe in Seattle there's enough. It's a pretty thriving startup ecosystem. But after a year or two, the answer seemed to be no. The answer seemed to be that in terms of companies that were going to get to scale, companies that were going to pay us back, especially as we started handing them more and more money, the answer was Seattle was too small. And the Pacific West was too small, right? That's our region here in the corner of North America. And as soon as we started looking beyond that, then we decided to just go everywhere. Right? There was no need to just say United States or United States and Canada. As long as we were looking for New York, East Coast New York and up to Canada, we might as well invite in everyone from Mexico and Latin America, and then Europe and Africa and so forth. So we quickly turned toward the entire globe to be our deal flow, looking for the best deals, as opposed to just the best deals locally. And that really shifted again. So the second bullet here on number 3, do you want to be the absolute best place just for your city? Or do you want to make your city the center of excellence for the region? And so anecdote here would just be like, to take a different region, to be like Nairobi, Kenya. So Nairobi, Kenya is a really hot market right now. There's probably a new fund each week starting up in Nairobi, Kenya, or targeting East Africa. There's dozens and dozens of funds on the ground there, almost all foreign money. It's now become the place to go. So the first place that Fledge ran a program in Africa was Nairobi, Kenya. And most of the companies we worked with were not Kenyan. They were from all across the continent, but that was a place to be. And so there's an opportunity to look beyond just the corner that is your city or the region in your country and say, all right, well, just like Singapore is the financial center, well, maybe the city that you're in could become the entrepreneurship center or an entrepreneurship center in Southeast Asia or the Indo-Pacific region. And that sounds maybe a little audacious, but it really just takes a few programs to get off the ground, right? Yours and a few others, until the entrepreneurs are starting to look there and the investors are starting to look there. And it's a feasible thing to do. Okay. Number 4, in terms of sector focus, we talked about this last week in funds. What are you going to focus on? Well, when you think about investing in the companies, when you think about bringing angels in to invest in your companies, what are all the pieces that they're going to want to look for? So is there the right match between what the investors want and what the entrepreneurs are doing? There isn't always that matchup. I did a report from the SONCOP conference in Nairobi, which is the last time I was there. It was 2 months ago. And we asked the investors which SDGs they were interested in. And we asked the entrepreneurs which SDGs they were tackling. And those two did not match up at all. They were way off in terms of interests. And that's going to be a problem. And I'm sure that same thing's true here in Seattle. And I'm sure that same thing's true in your city. Of course, we don't know where all the angels are yet, but once you start talking to them, you may just discover that what they want is slightly different than what you want. And my advice is to follow the money. So if they all want to invest in agriculture, then great, run an agriculture-focused accelerator. And if they all want to invest in clean tech, then run a clean tech-focused accelerator. And if they have nothing in common except they want to do impact, then you run an impact-focused accelerator. But you got to follow what the investors want, and then you have to find the entrepreneurs that match. And there may not be a match. That's totally possible. Okay, step 5 here is what do you do for the idea stage companies? So originally, when I started Fledge 7 years ago, every company that applied was idea stage. And the same thing at that time, 2012, the same thing was true in Techstars and Y Combinator. Every company that was running in Techstars and running in Y Combinator was basically 2 guys and an idea. And they would come into the program and they would leave with a different idea that was much more fundable and had a higher chance of success. That's what the accelerators did from 2006 till about 2015. These days, what I'm seeing is much more prototype stage and early growth stage, at least in terms of the applicants we accept. We get plenty of applicants who are in that stage that have 10,000, 20,000, 50,000, 100,000 in revenues. And so those are the ones we typically work with a few companies that have up $200,000 and $250,000 in revenues. So as you think through, well, where are we going to, what stage are these companies going to be in when they come through the accelerator? The question then is, well, what are you going to do for the earlier companies? Is that someone else's problem or is that your problem? And if it's your problem, what's that program look like? And how many programs between idea stage and investable accelerator? So this is more about ecosystem building. How do you make sure that these angels that you're teaching have the ability to help the companies at a stage where they're not taking way too much risk? What the problem winds up being with idea stage companies and investors is too many of them just simply fail. And of the ones that don't fail, it takes quite a while to get from idea stage to first customer to first revenues. And the extra long period of time just adds even more risk to the investments. So it's typically just too early for idea stage. Typical investing accelerators invest in the prototype stage. All right, so what criteria do you use today to pick your companies? When I summarize the criteria that I use at Fledge, I usually summarize it down to 3 things. So team, impact, and odds of success. Team, well, you all know you got to have a great team working on the problem. That importance of team goes way up when it comes to investing. When you talk to the angel groups here in the States and you ask them what's the most important criteria for picking an investment, they say team. And when you say what's the second criteria, they say team. And when you ask third criteria, they say team. Fourth is business model, right? Opportunity size, competition, other pieces come in there. You got to pick the right team. And you will learn after a few sessions that if you compromise on team because you loved their idea or you just love the impact they're having or you fall in love with anything other than the team, they will more likely than not fail on you eventually. And then you will regret falling in love with that idea instead of the team. You'll also learn pretty quickly that it takes a team to build an actual revenue generating company, a profitable company. A single entrepreneur, a solopreneur, has a way higher chance of failing. And the only exception to this is a very strong founder who's already built a team. So it's okay to have a single founder if that founder has a team of 2 or 3 people working for them who's probably going to stay there and help build the company, feel like early critical employees. But if it's just one person, just give them another program to work on until they find that partner. And if they don't find the partner, that's a red flag. Okay, in terms of impact, in my criteria, impact comes second. So I prioritize impact over returns, but I don't compromise the rate that I expect from these returns. So it may sound backwards, but what I mean by that is if I have two choices, and I think the return will be about the same for each of them, but one of them has a much higher impact in the world, then I'm going to pick the company with the higher impact, with the greater impact, and I'm going to measure that impact in my world based on total potential lives touched or scale of the impact. Excuse me. As in, is this company going to impact one city or two or three cities or a whole country or a whole region of the world or the whole world? That's my 4 levels of impact. And so if I have a company that is a little, equal teams, but a company that's not as far along, that has a potential global impact, I'm going to pick that always over a company that has, an amazing team and even some traction, but is only going to get to 1 or 2 cities. And then the last criteria is the complicated one. John will hopefully talk about that and dig into how you do that. I just call it odds of success. What are the odds that this company actually still exists in 5 years, earning, in my mind, it's always earning $500,000 of revenue. How long is it going to take them to get to $500,000 in revenue, annual revenue? How hard is that going to be? Who else is going to stop them? What's their competition to get in the way? How complex is their business model? How much money are they going to need to raise? All these extra little factors that are on the business side, the ones that the non-impact investors just focus solely on. All those pieces boil down to odds of success. Okay, so how we figure out what the criteria are in the Fledge process, and I talked about this a bit in Singapore. There's 3 key questions in our application, and I've done this on podcasts before. I've answered this question before on how you pick teams. I said if we could only ask 3 questions, these are the 3 questions we would ask. And the 4th one is actually the 0th question is what do you do? And please tell me in 150 characters. Don't give me an essay on that. So I have some idea of what they do, and then I ask 3 key questions. When did you start? How much money have you raised? And what were your revenues in the last 12 months? And that's almost verbatim how it's listed in the application. When did you start? On purpose, it's vague. We don't ask when you incorporated. We don't ask what day 1 was. Startup timing is vague in reality. So we just ask them when they started. We just want to know, is this a brand new company? Did it get started this year or late last year? Has it been around for a year or 2, or is it really old and struggling? And so we just want to know if it's a stale deal or whether we should discount the next 2 numbers because it's a fresh company. Second one is how much have you raised to date? I think there's a sub description in there that tries to tease out like all the money they put in as well as the outside money. Just kind of want to know how much money has it taken to get this far. And then the third one specifically says last 12 months because we don't always do applications at the beginning of the year. So how much money did they make, right? And so, if it's a 5-year-old company, you kind of read that a little bit different than if it's a 1-year-old company. But it really just, if you look at the hundreds of applications we get, they fall into 3 buckets. One of them would be something like the one on the left here, like we spent $10,000 and earned $1,200, or we raised $100,000 and earned $10,000, right? Or we raised $200,000 and earned $5,000. But the ratio is a lot of money in and not much revenues. We get a whole bunch in the middle, which is about equal. We raised $5,000 and we earned $5,000, or in this case, $4,700. We raised $20,000 and we earned $25,000 or $30,000 last year. So the ratio is about 1 to 1. Those are kind of rare. Those are kind of interesting. But the ones that are super interesting are the ones that are on the right. So we raised $20,000 and earned $180,000 last year, or last 12 months. And so in this case, the ones on the right, how long ago did you start kind of is important. The other 2, it's less important. But if you see a ratio and it's 1 to 5 or 1 to 10 or 1 to 20, you want to know, okay, is this year 2 or year 3 or year 4 or year 5? Or if it's year 1, it's even better. And we get enough of those that most of our invitees are in this rightmost column. And that seems to, I could just call this capital efficiency. And this capital efficiency seems to be extremely rare in the world, exceedingly rare here in the States. I don't think I've ever seen a company in the United States that has better than a 1-to-1 ratio. But out in the emerging markets, we see a lot of companies where the entrepreneur has been able to do amazing things with very little money. And then in the interview, when we get on Skype with them and chat face to face, then we'll dig in and ask more details. Like, okay, was it really $20,000? Is there a bunch of money you put in that you didn't list there? Was that outside money or inside money? And was that really $180,000? Or are you, are you like a retail store where it's really only 10% of that is yours and 90% of it was cost of goods? Sometimes we uncover that the ratio is really more like 1-to-1 when they're saying it's 1-to-10. And so that number on the right there's kind of two pieces here. There's the ratio, and then there's simply the number on the right. So if I simply asked you, if all you knew was their revenues in the last 12 months, well, which company would you pick here? The company that had $1,200 of revenue, $4,700, or $180,000? And anybody who doesn't say $180,000, well, if you're investing, remember on this piece, investing, then you're going to probably pick the one on the right. You're going to pick the one that has the most traction. And that's a term that shows up here in Seattle. I've heard it around the States. I've heard it in Africa as well. Investors like traction. And the best traction is customer revenues. John Seacrest asked, just take a, do any of the accelerators have data about their applicants around money raised in revenue? So if we can get a quick answer to that in the chat window, or anyone wants to come off mute. Is this something that you've asked in your application? And if so, do you keep those stats? Come on, I can see in the chat, in the participants window, we have some people here.
I know Sankalita is having some audio challenges.
Chat window is fine.
Chat, yeah.
All right, feel free to fill that in as we keep going. Moving on, oh, there we go. So Sankalita says, we do that in our Impactpreneur program, which is for growth stage companies. Yeah, and my suggestion would be to do it for the, as early as you can. So it doesn't make any sense for idea stage companies. So in that case, it should be, 1 to 0. You put a bunch of money in and you got nothing out yet, which is why they're so risky. But as soon as they get to revenues, right? As soon as they have 1 year's worth of sales, you have a statistic to look at and latch on. And it's a really powerful statistic. Here in the States, the norm is raise $500,000, right? And go to a typical angel group, and they're actually doing a little bit more traction, but go to an angel group a year or 2 or 3 ago, and the norm was we're looking for $500,000, and when we have it in the next 12 months, we will earn 100,000, maybe 200,000 in revenue. And in year 3 or year 4, we'll be earning millions, but we're going to have to raise a bunch more money to get there. With your $500,000, we'll get with your $500,000, we'll get 100,000 in revenue. Would be a very common thing to ask for in the United States, versus what I'm seeing overseas, which is, give me $50,000 or $100,000, and then I'll go make a company that's earning $500,000. Makes a huge difference when it comes to investing. And the more companies that we collectively can find and support that can turn $100,000 into $500,000, our problems of raising capital will go down. right, in the next 5 years. If we can find those companies, get them to success, and tell the world about it, people will be knocking down our doors to give us money. And that sounds hyperbolic, but it's true. I just haven't found enough that have actually gotten quite to scale yet. Working on it. Okay, one thing we don't ask in our application is we don't ask for a financial model. Those are the only numbers, right? How much did you raise and how much did you earn are the only two numeric dollar figures that we ask in our entire application. And we ask nothing more in the interview process. And the reason is, despite the fact that I'm finding entrepreneurs that are capital efficient, I am not finding in the world entrepreneurs who know how to build a financial model, right? Or build a financial model I believe in. And I don't want to take the time to try and review 300 or 400 financial models. So I simply don't look at them at all. Instead, in my interview process, I will try and flesh out a quick back of the envelope model for every company that I like. So I'm just doing this for 20 or 30 companies instead of 400. And then when they're in the program, then we work on financial modeling a lot. Okay, so one last thing on our on how to come up with the right criteria and how to use that criteria to rank your companies. There's this amazingly good tool out there. It's called 1000minds.com, and I was pointed to it by an applicant, by like 5-6 years ago. It works like this. So it's an online tool. It's wickedly expensive, but you can have 30 days for free. And the founder loves the idea that we're using this tool for this purpose. So if you ask him nicely, he'll give you 30 more days after that. The way the tool works is you come up with a bunch of criteria that you think are important. So here's just two. One is impact, and there's my one city, multiple cities, one country, multiple countries. In real life, there'd be a fifth one called global on the bottom there, at least in my model. Then we have traction. So it's an idea or it's a prototype with 15,000 in revenues would be prototype in my world. Or it's got some early customers, or it's working. And you can have as many answers as you want. These two happen to have 4 each, but you can have 2, or you can have 3, or you can have 5. Doesn't matter. As long as you know what they are and as long as you can order them from lowest to highest. That's all that matters. And then what the tool will do is once you've put in all the criteria you think are important, it will then randomly pick 2 of the criteria and 2 of the answers and ask you, which do you prefer? And these are not easy. They're actually really hard to do this. You're going to do this for like 45 minutes to an hour. Which do you like better? A company that has impact in multiple cities that has over 100,000 in revenue, or a company that is an entire country or potentially an entire country with less revenues, half as much revenues. Left or right? You will have a different point of view on this than I will, than your partners will. You could choose that they're equal, but ideally you pick which one's better, one left or right. And it will just keep doing this. It will just keep picking things, and every time you answer the question mathematically, it shrinks down the answer space. So it tells you at the bottom here in this version, there were 117 possible things to ask you, and what you can't see on this quick screenshot is if you hit left, it'll say, great, you just shorten that list by 8, and so now you're at 8 out of 117. So in this case, we're at 100 out of 117. We're probably 35-40 minutes into this. We're almost done. But it'll ask you over and over and over. It'll never ask you the same thing twice. But when you get your criteria put together, it does a really good job of making this really hard. And then when you're done with that, after you've completed all those answers, it will show you, this is the magic of math behind here, it will show you what your criteria actually is. It will tell you what the weights are for each of these criteria. And so this is a quick sample I did. This is not the real one that I use. So it shows you in 2 different versions. There's a spider chart on the left, but if we just focus on the line graph on the right, there's 4 criteria here: team impact, traction, and geography. And I don't even remember what geography is in this case. And you can see that what's most important to me in this particular run was traction. And I'll show you the numbers at the end here. And part of that is that there's 4 answers, but part of that is that was the number one thing I answered. So 40-something% of the total out of 100 you can get by having the most traction. And that team was number 2, in fact. So I said before that team is the number one thing. Team. What I discovered in doing this process was every time a potential answer came up and they had $100,000 or more of revenue, I didn't care what they said. I didn't care what I rated the team, because I simply assumed that in the interview process I did something wrong if they were already able to have raised 200,000 or 100,000 in customer revenue. So what I learned, another way to say this is, what I learned is I and everyone else is probably not perfect at picking the right team, but customers are going to be right about something. The customers buying the product are telling me that this team was able not only to produce a product that the customers wanted, but to sell it to the customers, to put a brand on it that the customers liked, to put a sales process that the customers liked, to do the marketing the customers liked, and therefore the traction was disproving whatever I thought about this team, which is why traction went first. I didn't even think of that before I went through this process. And then the other thing you can tell on this line graph is that team and traction are by far the most important criteria here. Impact, despite the fact I call myself an impact investor, peaks at like 14%. So global impact is 14% versus traction is 40-something%. And then whatever this geography criteria is, it doesn't really matter, right? So, you know, if they're the first answer or the lowest on geography, if they're lowest on everything, they get 0 points. If they're the middle one on geography, they get like 3% here. And if they're the top one, maybe it's 4 or 5%. It doesn't really matter. It's not going to move that company on the list very far. So when you run through this process, if you do use 1,000 minds and you come up with a criteria and it's this low on the list, you can just drop it and redo your criteria again. It's not important. Try and find that criteria that's missing here, that's in between impact and traction. So when I did this for real, which the last time I did this was about 3 years ago, I actually ran through that process 4 times to try and find the right criteria. I kept adding things in there and they kept coming back, like this geography one. So I threw them out and tossed in a new one, and it too wouldn't be more than 5%. So I threw it away, tried again, threw it away, tried again, and on the 3rd try I got one that I liked. And the other thing that's not showing in here, you can kind of see it in this black line, is that not all the answers are linear. So the team and the traction, they're quite linear. But what you might find is you have a criteria in mind that's more exponential. It might be that 0 gives you 0 points, 1 gives you a little bit, 2 gives you a little bit more, and then 3 gives you a huge number, right? And so you may find out that your answers are a little bit squished, or your true weighting is not linear. And you can also get a curve that looks the other way, which is 0 points, 1 is a lot, 2 is a teeny bit more, 3 is a little bit more. And so it doesn't really matter, you know, whether you rate them a 2, 3, or 4 on your criteria, as long as they have it, whatever it is that you're measuring there, you're happy with it. Okay, and so in the end, the other page it'll produce for you is this. This is the actual weights that you have for those criteria. And 1,000 minds will let you do this for the whole team. So you can have everybody on the team, if you have more than one person choosing, you can have them all do this together, and it'll give you the combined weights of everyone. Or you could do it separately, and then you can average them together yourself. So what you do is you take these numbers, you stick them in a spreadsheet, and then for each team, you give them a score. So here on traction, you give them a score of 1, 2, 3, or 4. And on team, you give them a score of 1, 2, or 3. And on impact, it'd be 1, 2, 3, or 4. And you simply take the number that matches up with the weight here, and you'll get a number from 0 to 100 on how much you actually like that team. All right, I'm going to stop there. Any questions on any of this? we'll just summarize and just say it's a far more complicated process than back when I was running a pre-accelerator, where when they wanted to write a check, we wanted them to come in, or the workshops where if they had an idea, we were happy to bring them in and give them some help. This is an investment process, and it gets to be complicated. So if there are no questions, I'm going to hand this off to John, and he's going to talk about due diligence.
Yeah. If I share my screen, does it do the right thing?
It will.
You cannot share while others are sharing, it says.
Okay, try it now.
Look at that. Let's see if I can find. No, nope, hold on. There we go.
Yep.
I gotta figure out which window I'm in. So when I'm working on the angel conference process is a training angel investors by doing angel investing. So it's more startup weekend than it is an MBA class. And so we'll go through and I'll talk over the angel conference flow a little bit so we are back in context with that. We can talk
John, for some reason we can see your little share bar at the top. Can you just shove that up in the right corner?
This thing here.
Yeah.
Resume share. How do I move it? It doesn't seem to want to move me. It's bottom. Is that any better down there?
Sure, it's out of the way of the text. Thank you.
All right. Maybe what I need to do is to stop sharing and then hold on a sec. Is that better?
Yeah, great, perfect. Thank you.
All right. So we'll talk about the flow. I'll talk a little bit about the pitch process because I think what we're trying to do, I think, is for people to develop both an understanding of the companies, but an understanding of the investors that are in the room with them. We hope that there's 40 companies and 40 investors. And in the process of mixing up in the pitch process, we see some preferences emerge, and then we double check with the due diligence about those preferences. So we basically spend a bunch of time, three months doing workshops. That ends up attracting the investors and it ends up attracting the companies. But it also ends up building a common vocabulary that the investors and the companies use, even when not all of the investors have come to the workshops, because it ends up being used in the room. So the conversations in the room are important. So if we look at that in the context of the accelerators, we might select some kind of pre-event activity that brings some relationship and some context between the investors that are joining before you select the applications, before the companies have completed their application. But we have a deadline at the end of that workshop series that gets you into the collection of companies. And I'm working on my angel conference process to move the angel commitment dates to be significantly before the company's commitment dates, so that I'm not trying to do both at the same time. And then we read through all of the applications, which are for us in Gust, and then select 24 quarterfinalists. We then hear 3-minute pitches, select the semifinalists, hear 10-minute pitches, select the finalists. And then we dive in and do a deep due diligence. And then we have this public event at the end where we have 10-minute pitches again, and then we go in the back room and vote and select one of the companies. From the data from Rob Wiltbank, we see that the Oregon Angel Conferences, the companies that make it into the finals significantly outperform the companies that do not make it to the finals. But the companies that win do not outperform the finalists. So we're relatively good at picking losers and removing them from the pool. We're not particularly good at picking the ones that are effective. And so to me, that means that there's significant amounts of noise in the process of running a startup that can kill the startup, even when you think you have a good team and a good product and a good process. So we hope we have 50 companies. We do the 24 selection. When we have less than 50, if we have 20 companies that apply, then we need to adjust this some. And so when we're in our very early stages trying to socially validate this in a market, we might end up spending more time with all of the companies than we do when we have 50 applicants. And we learned the hard way that if you end up with 100 applicants and then you try to, in a week, go from 100 applicants to the 24 quarterfinalists, that last meeting is quite painful. The significant part about these do the pitch and then the 3-minute Q&A, or do the pitch and the 10-minute Q&A, turns out not to be in the pitches. It turns out to be in the time before the meeting when everybody's getting together and we work the room for all of the investors to meet all of the startups. And at the end, when you said this thing in your pitch and I didn't understand what that meant, and now let's dive in a little bit deeper. And so with Alaska, we're doing it all remotely with Zoom pitches, and they've eliminated, as a result, all of the socialization at the beginning and the end of the meeting, and that's dramatically changing the interactions. So one of the things that's important is to provide meaningful networking time between the investors and the companies each time you gather everybody together. The pitches happen in a private room because we're asking them to share information about their company that they might not want to share in public. But we have all of the investors and all of the companies in the room. So the other companies get to see how they're doing against the other companies that are in the process. There's a significant amount of learning that happens by simply watching and paying attention to how other teams are pitching along the way. And in fact, sometimes that becomes really peer helping peer along the way. Once we've done this filtering, so if I know very little about the company and I say, well, I like that team or I like that idea, that might be enough to lead me to get them into the quarterfinals. But by the time I've seen the quarterfinal pitch and I've seen the semifinal pitch, I should know enough about this company to see whether or not I really want to dive deep on them. And hopefully in the meantime, we've done a coffee meeting with the company. We've done an internet due diligence with the company to see if the things that they are saying in their pitches are aligning. So by the time we've selected the due diligence leads and the time that we selected the team members, we're already diving into validating that the companies are doing what they're doing. And we're selecting the due diligence lead on the basis of interest. And so part of the subtle part of the program is trying to form teams of people who have a bias towards this company so that we end up generating champions. So even though we're in round 15, we're in 31 companies that have been invested because we've had champions develop, and then those champions have pushed for the second or third investment in some of the companies. And so we get additional investment as a result of champions finding that their company is particularly interesting to them.
And just to break in here, this is why I think, one reason why I think this model is going to work really well for accelerators is if you have 7, 8, 9, 10 companies and 25-ish investors, then you should have at least one champion per company. And the goal then is that the angels are the ones that are working on the follow-on funding after the accelerator. That the $5,000 or $10,000 that you've taken from them to start this off have gotten them so that they feel like owners of these companies and champions of these companies, and will go get their friends, the ones that didn't have time to be in the accelerator, but who have some money and who would invest if only there were someone else besides you out there pushing to get these companies funded.
Yeah, the ratio of people who are willing to learn about angel investing versus those that are willing to be leads of the process is it's not a 1-to-1 ratio. And so I would suggest that it's perhaps 1 to 2 out of 20. And so it will take, I think, some cultivation to get to where you think that could be. But I believe that with the proper pre-event workshops, you could actually set that probability up so that you could actually raise that broader round of money in the second round. Our goal is to get the due diligence leads to fall in love with the company, essentially. But we want them to do that not by going through a checklist, which then sort of blinds them to how the company's built, but for them to discover where the edges of the company are, where the edges of the thinking of the founders are, and to press on those and see how the founders respond to that. And then see whether, the founders are responsive, that they listen and they react, not necessarily that they agree, but they think about it and come back with answers to adapt to whatever risk is being identified. And as you identify the success points and the risk points of the company, to then decide as a group whether that combination is investable. So we ask the due diligence team of 4 or 5 people to vote when they turn in their due diligence report on, yes, this was a good investment, or no, this isn't a good investment. And of the 50 companies, we get 6 finalists. And of the 6 finalists, we typically see in Seattle 3 or 4 pass due diligence, and that 2 of them have some issue that is an issue that's stalling the investment team. And typically it's either there's something that's just really wrong, where you discover that their lawyer did all of the work pro bono in exchange for 49% of the company, and it just doesn't make the deal work. And so the other choice is that sometimes they're just too early. They haven't hit real live milestones, even though they presented very well. When you lift the cover, they actually haven't completed that traction. And so Looney's model of aiming for traction would select an older company than the ones that are typically making it into the angel conference that we're running in Seattle. So we have companies with traction that don't make it to the finals, which I often find interesting, and then that becomes an interesting conversation later. And since the goal of the angel conference is not to make great investments, it's to enable people to learn how to do angel investing. We don't ask people to go to the point where you get to know and then stop. We ask them to sort of press around all of the edges and do a relatively complete study of the company and feed that back to the company. And even though, you know, maybe in the second due diligence meeting, everybody's pretty convinced that the answer is no, there's still bright spots in the company and there's still other risks that need to be addressed. And we ask people to complete that all the way to the end. So that conversation has come up recently. We're in the due diligence for both Seattle and Alaska at the moment, where some of the companies have issues where some of the members of the due diligence committees are, you know, they hit no, they've done investing before, they know this is not an investable company for them, they think they're done, but in fact they're not. And then we know that there's core issues, you know, the classics of team, market, product, and finance models. And so we ask people to check in on those. Team often being the key question, because what we're trying to discover is whether we really want to be engaged with this group of people for the next 10 years. And we talk about that often. And then we want to see that the things that they were saying in their pitches actually have outside validation for what they said, what they think the market size is, what they think their competition looks like. And then we want to talk to their customers. We want to go and do the site visit and basically do a third-party review of the information that we tested on that. And the act of getting the investors to go to the site, to get the investors to talk to customers, to get them to engage in the competition evaluation frequently either causes them to sort of throw up their hands saying, well, look, I Googled these guys and there are 15 competitors and they don't seem to know any of them. Or they fall in love with the company and they dive in deeper on things. And so again, it's a process of making sure that people are doing what they say they were going to do. And since what we're trying to do is to have 50% of the investors having written checks before, they have a mental model in their head of what an investment looks like. And so if you have 100% everybody in your program is a brand new investor, then I think it's probably worth our while to put together a stronger pre-investment program that's sort of a, you know, training boot camp for angel investors that goes through a bunch of the ideas. In the angel conference, I stay away from checklists. I say that they can go to the internet and find dozens of them, and you need to pick checklists that are stage appropriate. So when I give you a checklist and it's appropriate for a growth company, probably not an appropriate thing for an idea or concept stage company. And it's also probably not appropriate for the first MVP, first customer stage companies. And so developing a stage appropriate, industry appropriate, context appropriate checklist is a useful activity for the angels to learn how to do. And when you give, especially some of our high-tech engineers in our Seattle area, you give them a process with a checklist, they run through that checklist really efficiently, and then they don't look beyond the checklist, which is exactly a way to find a company that checks all the boxes and yet is not a meaningful, functional company. And our goal is to explore what are the risks that are going to kill this company, and then watch how the company responds to that expression. So we provide feedback to every company that goes through an hour sit down with someone from the program to review why they got, how far over they got. And when we get to the finals, that due diligence sit down is typically done with the due diligence lead to walk through all the things that all of the due diligence teams thought about them. Now, in our process, when we select the due diligence team at the end, we're at the end of the semifinals, we select the finalists, we leave that meeting with the due diligence team lead and 3 more people, so typically 4 people on a team. And then each week for the next 3 weeks, we visit with people. The meetings, the first meeting is with all of the teams and all of the investors, and we sort of do the basics and try to get, company formation and the core things done in person and get everybody meeting everybody. Again, trying to build relationships over the coffee and food. And then the subsequent weeks, we're asking, what did you do? What will you do? And where are your barriers? But we're then also asking of all of the other teams, what is it that you wish you knew about this team that's presenting right now? So we want one due diligence team to ask another due diligence team to ask their company a specific question, so that the issues across all the companies start getting evaluated on an even footing. And we basically do stand-ups for 3 weeks. We then do a mixer the night before the final event to get all those interpersonal relationships touched again, but also to answer any of the last-minute questions and to see how the teams have built relationship with the investors and how they work the room. So there's a bunch of soft skills that happen in that mixer, which is also part of this due diligence process. And then on the final event, we end up doing a big keynote with someone who's interesting to the community and inspiring, then a bunch of 10-minute pitches, 5-minute Q&A to sort of demonstrate in public how the due diligence works. And then we let the audience talk to the companies, the investors go into the back room and discuss. Along the way, we've been practicing our votes so people have a sense of where the room is. That helps us shorten the vote. But we're basically voting, narrowing in on where the group is, trying to get a group investment. This is a put your money in first, and then we all agree on the end result. Not that everybody really agrees, but we want a super majority to prefer whatever option we're going. Sometimes we can't get there. Sometimes we split the pot in half and select 2 of the companies because the room splits in half. Sometimes we raise another fund immediately right there. And we've had, there was one time where we more than doubled the money and split it. So it varies. Our goal is to have the LLC lead, the person responsible for the company that contains all of the investors, to build the muscles to be a lead investor. And so they manage the question of, is this a good deal? And we focus the investors on the question of, is this a good company? So as we're doing due diligence, for the most part, we're asking them, is this a good company? Does it have what it needs to be a stable, functional company? And then the due diligence lead at the semifinal selection date, when we go to select the finalists, we want to have the due diligence lead veto companies that they think are not a good deal. So if they think they're too high a valuation, or they're very, very opinionated about things that are not going to be acceptable after a few minutes, then we just don't take them into the finals. I'm not sure how that would work in the context of all the companies get into the program and all the companies get funded. So I think we'll have to think about that a little bit.
Yeah, it's one of those answers of that I've seen, at least, of let the money choose. So if the angels are putting money up at stake and they have chosen these companies, then you gotta let them do that.
Right. Well,
Learning how to learn, yeah. As much as it's a waste of money, learning how to fail and pick the wrong companies is something you gotta teach the ecosystem how to do.
Yeah, but it's useful to learn to fail with $5,000 instead of learning to fail with $100,000.
Oh yeah, so, way more useful. This is, and what I didn't say on my piece here is We didn't start with $20,000 checks in Pledge here in Seattle. We started with $7,000 checks. And then we did 10, and then we did 12. And we worked our way up to 20, knowing that we were learning the process along the way, knowing that the deal flow would get better over time, and learning that it's really hard to raise money. So providing $7,000 to 7 companies is only $50,000, whereas now we put way more than that at stake each time we run the system.
I think it would be useful in our discussions for the second model to have essentially 2 rounds of funding, the round of funding to get into the accelerator, and then a second round of funding where they as a group are still working together to raise that second round of funding. Even if they're bringing in people from the outside, I think there's programmatic value in having them working together.
Yeah, in general, what John and I do agree with is, in 5 years or 7 years, this will look different.
Yeah.
That we don't know what the answer is yet. We think we know what probably will work. And one of the things that's exciting about working with frontier incubators and all these groups around the world is we want to bring back the knowledge you gained from doing this and spread that around the network and spread that around the world to help find that. We're never going to have all the answers just here in Seattle.
For sure. So we know CV Insights did an interesting study suggesting that there were reasons that companies were failing in their portfolio. They interviewed like 115 companies that had failed and say, why do you think you didn't do very well? And they say number one is, we didn't have anyone that wanted to buy our product, which, the lean startup folks tend to think you can figure out a cheaper way to discover that answer. But the hidden piece of information in this chart is all of these companies had angel investment already. So they had already been filtered for team. And so I would argue that really the number one issue is team, that market and customer development is the number 2. And then understanding the product risk versus the execution risk, which they don't pull out very well in this image, are really the next level of risk. However, there's interesting questions about which companies succeed. Why do the companies succeed? Turns out that close to half of it is that they're on the right trend. The market is doing what the market is doing, and they have an opportunity to step into this market now. If you step into a market too early, you are playing the role of a nonprofit, educating the market at the expense of your investors and your employees. If you come in too late, there's too much competition. It's just too expensive to be in the space. So there's, being in the sweet spot about when it happens. And then we get to the team and the idea, and then what the business mechanism is. And then our funding, which we find that the journalists like to talk about so much, ends up being less than 15% of the consequences of what causes a company to be successful. So hopefully you can have a team that has an interesting idea with a business model that works, that's producing traction, and that they sit in a market that's going at the right speed, and then adding a little bit of money makes it more likely that they're going to succeed a little bit. And we start with those 2 diagrams, the why they fail and why they succeed, and then ask them to go validate for the company what it is. And for the last couple of angel conferences, I've been going through and just writing down the issues that are discussed in the due diligence meetings. Did you talk about the team? Did you talk about the finances? Did you talk and the subtopics inside that? And typically we're seeing something like 100 different subtopics touched in any due diligence report out for the teams, from intellectual property issues to financial modeling or revenue models, all the way into details about team and structure market size. And so those conversations have gone relatively well for both San Diego, Kelowna, and Seattle in the last round that I've been keeping track of. There's a couple of books by David Rose that I think are useful. His startup list, I think, is extensive, but for a little bit later stage than what we typically look at. And I think there's a couple of articles that I didn't have time to go get the reference to that I want to put in here. Are there any questions that people have? Sorry, not getting any questions on my side. I'm not hearing you, Looney. Let me.
Oh, I'm on mute. Sorry. Last call for questions of the night. If not, we are always open for questions on Slack or by email. And we'll see you in a few more weeks to wrap up the webinar part of this and start getting into the details on how to launch one of these in your own city.
Yeah, so I want to talk a little bit with you, Looney, about where I have a little friction that I think would be worthwhile. Yep. So I separate, is this a good company from, is this a good deal? And if I have a bunch of people that are traditional angel investors and they're investing in an equity growth stage, unicorn hunting sort of way, that makes perfect sense. You can do that, right? We sort of assume that. But if I'm looking at a company that might use revenue redemption where margin is more important and margin and traction get me to someplace, then I need to have this discussion among the due diligence teams about what's the piece of the business model that actually gets to a return, which currently is not happening in any of the conversations except for Alaska, because they're explicitly starting to look at the revenue redemption. So
and that's one of those key differences between the accelerator stage of startups and the angel stage of startups, is that the companies that apply to accelerators, with at least that I've seen, with rare exception, have not raised money from experienced angels yet.
Right.
And so the standard deal when you put it out there is probably the right deal for them. It's probably the right price, because basically accelerators, if you guys haven't seen this yet, accelerators get a really good deal when it comes to the dollars that they put into companies. And that's because we're putting in all this other effort on top of our dollars, and entrepreneurs, the ones that are applying, value that in at least as much as it's worth. And so I've I don't know about never, but I rarely ever have to ask the question of, am I getting the right value for my dollar? Mm-hmm. Just because the numbers work out that way.
I wanted to make sure you guys saw Min's question in the chat.
Yeah, so evaluation numbers is always a big problem. And so, Min, do you mean numbers in terms of quantitatively evaluating companies, or do you mean numbers as in, okay. So I'll just jump back there for a second. My original process for picking companies into Fledge was to put Post-its on my window in my kitchen, which is where I'm sitting right now, and then sort them by a bunch of criteria like, okay, what is their impact versus traction? What is their impact versus funds that they'll need? And we would do that for like a half an hour, just moving the Post-its around, trying to get some quantitative numbers out of a bunch of what seemed like qualitative answers. And some of the companies would just kind of always be up there in the upper right corner, right? Up and to the right is good in all these cases. And some would always be in the bottom left corner. And so we'd start removing the ones from the bottom left corner and taking the ones in the upper right corner and talking about them. And that was the original process. And then 2 years into Fledge, or not a year and a half into Fledge, one of the applicants shot me to 1,000 Minds. And oh my God, all of a sudden, I had a way to quantitatively measure all of those things all at the same time. And so these days, when I'm sitting in an interview, literally at the end of the interview on Skype, I will pull up my spreadsheet, toss in some numbers, and out pops a single number percentage. And sometimes I'm surprised by what the number is. But it's like, okay, well, this was a great team. My teams are now 1 through 5. This is a great team. I understand their impact. I think they could be national, so that's a 4. I believe their traction now, so that's a 1, 2, or 3, and a few more things that are that come out of that, and boom, okay, they're a 62. And then I will sort them in the list and go, oh, and then I'll thank them for the call and whatnot while they're just wrapping up. I like to multitask. But sometimes I'll do that at the end just to see where they are in order to let them down easy, to be able to say, well, I really like the conversation, but odds of you getting in are pretty low here. You're way below the cut line. And then turn that sad story into some mentorship for them instead, because I like to give everybody at least some advice. So that, I can't accept everyone in the program, but I can give everyone advice. Advice is free. But then when
the advice right, it's transformative, and they come back later and they
the hope is that they apply again, and I'll always ask them, you go off, do this, and you'll go up in the list.
Right.
And I'll tell them the story about Mavis, who applied 4 times and all that. Especially if they're really near the cut line, and I know I'm not going to pick them. I know they're not going to make it. But in the end, after the call, before the next call, I'll have them. They'll be in the list. They'll have a number attached to them, and then I can reflect on that and go, okay, especially on the list. Well, they seem to be around the same as these other companies. Why? And then I will look at the numbers I typed in for them and try and figure out, like reverse engineer my own criteria to say, oh, okay, so in this case, it was team interaction, or it was impact, and the amount of money they need to raise. Is that accurate? And sometimes I'll actually change the numbers a little bit, and that'll change the final score. But I get a number that is extremely helpful. And then the thing to remember when you have these numbers, and John mentioned this 6, 7 slides ago, we know why companies fail. So what that 0 through 100 score actually is measuring is not odds of success. It's the inverse of odds of failure. So as whoever gets a 0 on that scorecard, and I don't think I've had a 0, but I've had like a 6%. If they score way, way, way down on the bottom, they're being scored way down because their odds of failing are really high. And if they're basically, in my criteria, under 50%, their odds of failing in the next few years is basically 50%, right, or higher than 50%. So they got to beat 50% in my personal criteria, and yours might be different. Your cut line might be different. And so typically the scores I'm getting for the invitees are between like 55 and 75%. That's a pretty narrow band. But I'll interview 30 companies, and they will span 75 to 10 when I'm done. And then I can justify. The nice part about this, beyond just getting the list, is I can go back to them. I can go back to anyone else and say, hey, here's why we did not accept that company. It's missing this, and you can clearly see it on the numbers on that criteria, right? It's still idea stage, so it got 0 points on that. Or the team, I like the people, but they didn't prove to me that they were the right people for this project. And if they're not the right people for the project, they're not going to get a 5. They might get a 4. Like, they seem like they know what they're doing, but there's something missing, so they get 1 score down. And so you can point to all these things and go, oh, well, that's why they didn't get in. And, sending all the rejection letters is never fun in our business. And at least when I go back and I send all these rejection letters, and I do them all one at a time, at least I can kind of point them back to what they can work on.
So I think that the other thing in that question is that he's talking about, or she is talking about the cohort and the structure of the cohort not actually being in the same level. And so it's actually relatively difficult if you're doing a program where you end up having someone who has no traction and someone else that's doing 100,000 a month. That ends up being actually quite hard to manage. I wonder how you approach that when you have a wide range, like pre-seed, seed, and Series A all in the same room trying to help each other. Is a lot less useful than you think it might be.
Yeah, and I have run cohorts with idea stage companies in 200,000 in revenue and everything in between. And I've run cohorts with Americans and Africans and Latin Americans all in the same room.
And how did that go?
It goes pretty well. So ask me again in 3 months when I'm done with this cohort, which is a lot tighter together. But it's gone well because I think we have critical mass of enough companies that they don't all have to help each other. We just need one or two to help one or two. Secondly, because the earlier companies always get something out of being in the room with the later stage companies. And because the later stage companies, and later stage being, 100, 200,000 of revenue in this case, the ones that apply to an accelerator tend to be missing something, missing some knowledge. The ones that are, 200,000 and next year are going to make 500,000 aren't applying to accelerators if they know how to get there. And so the ones that apply tend to want to learn something and are lifelong learners and are willing to sit back and understand that they might learn something from this idea stage entrepreneur. So I think it's more of a culture of picking the right culture of entrepreneurs than the fact that they're that they vary a lot and they're diverse. Okay, so with that, we are at time. I don't see any new questions. Okay, one more question. Min said, could you send me some rejection letter samples? I can try and dig that up. I think I have a file of those. But typically what I do, just as general outline, is I have a cut and paste letter that I'll send, which is, thank you for applying. We had, this one will be 454 applications and we only had room for 7. So it was next to impossible to get in. And then there'll be blank. And then I'll type in a paragraph on a reason or two on why they didn't get in. And if there's an obvious suggestion on what they need to do next or focus on, then I'll do that. And then just a thank you at the end and say, please apply, right? We do love it when people reapply. And that's about it. This isn't Ian's program. We're not providing 4 pages of feedback on their plan. Just trying to get them just 1 or 2 little tidbits that I would give them if I were in the room with them, just to help them. So does that help? And often it's something really obvious, like you just need to sell. Some of them are really hard to write, but it's like you just need to find a way to get some customers. Like I love what you do, but you just don't have enough customers yet. And that phrase is something like, many of our other applicants were able to earn more revenue on less investment dollars. Right back to my capital efficiency. Or it might be, hey, you need to watch out for your cost of acquiring a customer. The kind of business you're running is one where that is usually the area where there's failure, or little tidbits like that. So I have some blog posts on patterns. I think if you search on my blog, the Lunar Mobiscuit blog on patterns, you'll find some blog posts on things that we see that they can't see, because we're seeing a bunch more deals than they are. So it's either called patterns or it's called information asymmetry.
So what are we doing next time?
We'll post that when we look it up. I don't know at the moment, and it's late. So, we'll hopefully see you next time. Oh, unfortunately, I was supposed to send that to everyone. All right, we'll try that again. Before you leave, it's lunarmobiscuit.com blog and search for patterns or information asymmetry. Or it might be something like what investors know that entrepreneurs don't. It's hard to remember all the blog posts now. But thanks for showing up, and thanks for
Thank you,
watching.
John.
Thanks for watching if you're watching this at home.